Hey guys, welcome back to the channel. This year I said that Netflix was my top stock pick for 2024, and I made it the second largest position in my portfolio based on that. Little did I know that I'd be rewarded so quickly, as Netflix has just reported earnings and the stock is up nearly 17% within the last week.
The company had been expected to add about 9 million, just under 9 million new subscribers, but instead it reported 13.12 million.
I was really impressed by this earnings report, but I still think Netflix is undervalued, even after the price spike. So today, let's go through the earnings report and I'll tell you why I'm still going to be picking up Netflix shares at this price. In addition to that, Visa also reported earnings, and as I'm a large shareholder in them as well, let's go through the earnings report, so stick around to the end to see that. Netflix beat revenue estimates but missed out on earnings per share. However, the real statistic that excited the market was subscriber growth. Netflix grew its subscribers by 13.1 million new subscribers in Q4 compared to the market estimate of only 9 million. That's over 50% more subscriber growth than what the market was expecting, and that's why the share price shot up so much. In 2021, the market had assumed that Netflix had peaked out at around 220 million global subscribers and that there would be no further growth in revenue and subscribers over time. And how wrong it was. Netflix is now being re-rated to a growth stock once again, and if you look at a graph of the total number of subscribers, it is going up at a constant trend line. It seems like 2021, 2022 was only a small blip in the constant march upwards. In my opinion, Netflix is one of the best run companies in the world, and that extends especially to the content they produce. According to Nielsen, a video streaming service which compiles data from all of the streaming services and ranks which ones are most viewed, Netflix spent 48 out of 52 weeks as having the #1 best original TV series. In addition to that, it also spent 41 out of 52 weeks as having the best original film and 44 out of 52 weeks as having the best acquired TV series. Those numbers are absolutely insane. With that level of content quality, there's no wonder that Netflix has the lowest amount of churn or people cancelling their subscriptions compared to other video streaming services. Netflix has a churn rate of only around 2% compared to a weighted average of 5.3% for the rest of the industry. That's not even close. The subscription model is one of the most reliable revenue generators for companies, as customers are usually unlikely to cancel and they provide a very reliable, consistent and steadily growing source of income for a company. So it's no wonder that they've proliferated so much, especially over the last few years for internet companies. But with this kind of proliferation, customers have become sick and tired of the number of subscriptions that they're signed up to and the amount of money coming out of their bank account month in and month out. So it's no wonder that the number of cancellations on subscriptions are soaring over the last year or so. The fact that Netflix has been able to buck this trend whilst increasing its prices and cracking down on password sharing is extremely impressive. Many people said that the crackdown on password sharing would lose Netflix millions of subscribers, but in fact the opposite happened, as the company lent into the criticism and actually allowed people to add other households as a paid for feature onto their account. I actually think this increases the stickiness of the Netflix service, as people are going to be less likely to cancel their Netflix if it means they're going to be cancelling their mum's Netflix as well that they're paying for as an add-on. Netflix also launched its slightly cheaper ad tier last year, and last quarter it actually grew 70% year on year. That kind of growth is absolutely crazy, and the company confirmed that nearly 40% of all new signups in ad tier supported regions are on ad tier. And before you might think that ad tier must make Netflix less money, it's actually the opposite. Ad tier makes Netflix more money than the premium tier, and they have a partnership with Microsoft to personalize ads for users, and as that continues to develop, I'm sure that revenue per user on the ad tier will only continue to increase. Well, now you might be asking yourself, where is the growth coming from? After all, everyone already has a Netflix subscription, right? Well, no. If you look at this graph from the Netflix earnings report, you can see the percentage of TV viewing time that is on Netflix and other streaming services versus linear TV. And the percentages are still extremely small, less than 40% in almost every single market, and it's way lower in developing countries where broadband coverage is still expanding, and I expect that number to increase over time there especially, and also in developed countries. Linear TV is dead. People might not have got the message yet, but it is definitely dying. It's not fully dead yet, and there's still plenty of time for streamers to eat its revenue up. In Q4 2023, Netflix grew its revenues by around 12%. Or 13% on a constant currency basis, which I think is a more accurate measure anyway. But it's really when you look at their guidance that you can see the kind of amazing potential for Netflix stock. Netflix said it would grow its revenue by 13% in Q1 2024 or 16% on a constant currency basis. That kind of growth is extremely healthy, and it goes right back to the good old days of Netflix as a growth stock. Except back then, it was making free cash flow losses every year, whereas now Netflix is extremely profitable. It's making profitable free cash flow, and it's growing it every single year. I really don't see the downside in Netflix stock right now. What about valuation? Well, Netflix trades at around a 32 to 33 forward price to earnings ratio and a free cash flow yield of around 2.8%. In my opinion, that's an extremely reasonable level for a company which is growing at the kind of rate that Netflix is. If you put this in comparison with Microsoft, another tech company, Microsoft has a forward price to earnings ratio of nearly 37 and a free cash flow yield of around 2.1%, whilst growing its revenue at a far slower rate than Netflix. Netflix is also doing share buybacks, reducing its share count by 1% plus per year, and it has a very reasonable amount of debt. Which company would you rather buy, Microsoft or Netflix? Well, at this kind of evaluation, by far I would rather pick Netflix. When you buy a company, you are buying a percentage of its future cash flows. And if you can estimate what its future cash flows will be, then you can effectively get a valuation of the company today. When you're doing that kind of evaluation, it's called a discounted cash flow analysis. And you discount the future cash flows by the percentage rate that it would be devalued by say inflation, or what you could get if you had put that money into the S&P 500, for example. When I look at Netflix and I put them in a DCF, the valuations are crazy, and I had to double and triple check the numbers to see if they were accurate. When I plug in a discount rate of around 10% or the S&P average return and an expected revenue growth rate of around 10%, which is less than what I actually think the company will grow over the next 10 years, and the historical levels for EBITDA margin and capex margin, the company is significantly undervalued still, around 57% undervalued. In fact, the fair value of the price of the stock should be around $900 per share. But obviously, the fair value of a DCF is based on your assumptions being true for growth and margins. If those assumptions don't turn out to be true, then the fair value will be something else. So don't take it for granted that the fair value is $900. That's just what I personally think. Moving on, let's talk about Visa's earnings report. The company did perform pretty well. It beat on earnings per share estimates and revenue estimates, and that didn't really come as a surprise to me, as the company has only come in below expectations once within the last 12 or so years. So the stock sold off anyway in spite of the beat, and that also didn't come as a surprise to me, as that has happened in the last few quarters as well. The stock has traded up a lot within the last few months, so I think a little bit of steam being blown off is not that bad. Visa grew its revenue year on year by around 9%, and it posted its guidance for the full year for 2024 as growing its revenue by high single digits levels or low double digits levels. So around 10% in my opinion. That pretty much follows my thesis for Visa, and I'm probably just going to hold onto the stock. As expected, this earnings report doesn't really have any new information, but the company is posting solid growth and it has continued to do its thing. Visa's growth was pretty much driven by the strength of the US consumer as well as international growth. Cross-border spending also made up a large proportion of the growth in revenue of the company, and it's no wonder as Visa makes a percentage of every single financial transaction pretty much that is done by consumers. So if the consumer and the economy is doing well, then Visa will also do well. The only thing to look out for is if there are any signs of consumer spending weakening this year, that may slow Visa's growth somewhat and affect the stock price, as the valuation is a little bit stretched now in my opinion, and I think it's just a long-term hold due to the qualities of the company. To wrap up, I thought Netflix had a brilliant earnings and I think the stock price is still undervalued. I think my position in Netflix is only going to grow as I buy more stock this year. So let me know what you guys think about Netflix. I think Visa also is doing well. For me, it's probably just a hold. I won't be picking up any new shares for now unless the price drops, but I think it's still a great company. So I will be covering next week probably Meta and Google's earnings, so give me a like and subscribe if you enjoyed this video and you want to hear about those too. See you guys next time.